Right, hello everyone, and welcome to this, the fourth in our series Bitcoin and Gold in 2022 webinars. We are delighted today to have Mark Valek from Incrementum joining us, and I'll go on to introduce him in just a moment, but a little bit of housekeeping to start with. The usual one, this is not financial advice, it is purely infotainment, I suppose. Secondly, do ask questions either in the chat or the Q&A, and we'll try and feed those in either as we go along or at the end. There will be a recording available for people who want to watch this later or pass it on, so do have a look on our YouTube site. Right, with all that said and done, it is time to say hello to Mark Valek. It's a great privilege to have him. Mark is portfolio manager and head of research at Incrementum AG. He's the first of our guests to be an expert in both Bitcoin and gold. The previous guests have all been gold bugs, so it's great to sort of build the diversity. Mark, he's got particular responsibility for the crypto gold fund and the digital and physical gold fund. Before he was at Incrementum, if I've got this right, he spent 10 years at Raiffeisen Capital Management, where he had responsibility, and I love this, for inflation protection and alternative investments. Now, it's sort of inflation protection in a time when there wasn't really much inflation, it seems to me. Anyway, a long history in Austrian economics, and he was the co-author of the Austrian School for Investors, which was published in 2014. Hello, Mark. And can we start just by how did you, I mean, I guess the sort of Austrian economics theme is a big clue, but how did you first really tumble into the world of gold in particular?
Well, good afternoon. Thanks for the invitation. Yeah, well, the journey has been going on for quite a while, actually. So, as you already mentioned, I mean, I was started my career in finance pretty early, and I was actually my curiosity in how things actually work brought me into the financial sector. I mean, starting out to trying to figure out how the financial markets work in general. And I went through, like, I would say, a pretty standard education when it comes to, on the university level. Business administration is probably something which one would likely pursue when one wants to go into this kind of field, and which I did. I never really found the right answers there. Also looking into traditional economics, classical economics, which is taught at universities, typically some kind of a branch of Keynesianism, and it wasn't until 2007, 2008 that I, ironically studying in Vienna, Austria, had heard of the Austrian School of Economics. I was already working as a portfolio manager back then, and that really caught my attention, because that was really something very different to what I had heard up to that point, and it I think mainly it differs. I mean, it's very array of different perspectives, but perhaps one of the main points which is really different to the traditional view is the view on the general monetary system. So that caught my attention. Got very interested in monetary history and fell into that rabbit hole, and yeah, then the rest is history, I guess. So 2008 was my red pill year, not only because of the financial crisis, but just coinciding with that event. Austrian economics came to me, and I embraced it.
Kind of makes a huge amount of sense, doesn't it? I mean, it was such a massive event, and people were looking for some sort of framework to try and understand it. Did the sort of subsequent years, you know, the way policy evolved, surprise you?
Well, to some extent, definitely. I mean, I think the whole financial markets were going through kind of the process when the crisis hit and QE initially started. Everybody had to start making sense of that. What is this now? Because it was unprecedented, at least in recent financial history in the Western world, at least. So nobody really knew what does that mean, and is it going to be hyperinflation tomorrow or not? Or so everybody had to figure out, okay, how is money created, and broad money supply versus central banking monetary supply. And then this kind of stuff fascinated me, and I mean, I think I wasn't like in the super hyperinflation camp, but I definitely was aware of or was sensitive to inflation. I think inflation did happen. I mean, even consumer price inflation happened shortly after the GFC. So in 2011, there was so like 4.4%. I think in the US year over year was the high point. So it wasn't that there was zero inflation, but definitely wasn't high or hyperinflation in terms of consumer price inflation. But what obviously happened is we had a huge asset price inflation, and the most surprising thing for me is how long this actually continued. So it turned out that we had a decade of ever increasing QE and ever increasing asset price inflation, financial assets that being mainly. And I think the table started to turn in 2019, probably, definitely 2020 when COVID hit in, and they increased it another notch, and now we've going from one inflationary crisis to the next. So it's pretty unreal that it's all happening now.
And I think if you go back to 2008, it is, it's easy to forget how big a deal it was at the time. And I think people who don't remember it because they weren't there really need to look back at the extreme destruction we saw right across the board. And I suppose there was a school of thought that said inflation won't come back until the banks are fixed. Now, you can debate whether the banks are fixed or not, but they're a hell of a lot better capitalized today than they were 14 years ago. And I think that's, when we're looking at the post-COVID world, we've had the stimulus in 2020, and now we've got the supply chain, the end of globalization, these sorts of things, on top of, banks with strong balance sheets. And it's a game changer. There's the deflationary forces have just disappeared, haven't they?
Yeah, I mean, I think it's a total game changer. I think COVID already was a game changer, but I do also subscribe to the thesis that basically the monetary expansion which was going on in the 2010s it hasn't been fully accounted yet, and not even talking about the last 2 years, what happened in the last 2 years, which is even more crazy. But so there's so much potential energy, if you want to look at like in this kind of perspective, for much higher price inflation, just from looking at it from a monetary point of view. Monetary velocity being so low, I always thought of this as being a temporary thing, and I still think of it as a temporary thing. I mean, we haven't even seen monetary velocity increasing, but we saw huge monetary inflation, obviously, and now we are already in the phase that this price inflation is very evidently kicking in. So I think part of the process which is going on right now is basically coming out of almost 3 or 4 decade disinflationary environment, the great moderation, as they called it. The general collective mindset towards inflation was very ignorant, and this is starting to change now. But it's still not comprehended by a lot of people, in my view, and I think it will take some time until this kind of collective mindset will increase again and be more aware of that we're entering an inflationary period right now.
I mean, what's incredible what you just said, I don't know if people picked up on it, is the velocity of money hasn't turned up yet. So we've had all this and we haven't actually had the big one that comes down the line. That's enormous. I was asked recently of how all this plays out. And I think that the answer lies in foreign exchange. We're going to see crazy moves in FX, which are beginning. Obviously we've seen Turkey, we've seen Russia for different reasons. And right now you could say we're seeing Japan, and the Japanese yen's been selling off quite aggressively. And there's a couple of things about zero interest rates that are interesting. The first one is obvious, that is they're zero, which is a low number. But the second point is when everyone's zero, all the interest rates are the same. And FX is driven by rate differentials or real rate differentials. And so when you haven't had any differentials, you haven't had much FX, which is why there have been so few trends and moves, bit of risk on, bit of risk off, but no structural moves. And I think that is how it's going to play out. One shoe drops, then the next one, then the next one. And then the last one is probably the dollar, which, to your point, may well be driven by the turn in the velocity.
Right. I mean, dollar is a very special case, and there have been ongoing debates whether it's going to be strong or weak. I mean, let's face it, we still live in a basically dollar-centric global financial system. That's a fact. But I think one of this most recent, one of the consequences of the most recent events is, I think the change, the potential changes in the global monetary architectures probably will start increasing. I mean, we talked about this a little bit previously offline, but I mean, when it comes to freezing reserves and so on, basically the world was just now given an example what can happen to your reserves once you're not friendly anymore towards the West, for instance. So I think everybody who has considerable reserves probably rethink and reconsider in what kind of, where do I store my value? Where do I store my, as being like talking from a point of view of a central bank, where do I store my international reserves? And at the end of the day, mostly the discussion always was, when it comes to de-dollarization, well, would it become an alternative fiat currency? But I don't think so, because all fiat currencies basically have the same problem. They're prone to inflation, and they are connected to a government. So the obvious answer is a non-political store of value, and I think the value for that being obviously primarily gold, but potentially even Bitcoin. So this is, I think, a huge case which has been made for non-government liquid money, which is non-inflatable.
Yeah.
Forward.
It's a tough one, isn't it? Because there are, as you rightly say, there aren't many alternatives, and the US dollar, frankly, is kind of the sort of the best of a bad lot. I mean, it's turning into a sort of a means of gold into a sort of a regularly used means of exchange is quite. It seems quite far off at this stage, despite all the things you said. But can I take a step back, because we also had talk about Bitcoin, of course, and the same question really is at the start. How did you fall down that rabbit hole? And how is you're now managing it in an institutional fashion? How has that evolved? Since first stumbling upon it.
Well, as you may know, or your viewers may or not know, we write a very extensive report on gold, which is called the In Gold We Trust report. So I write this together with Ronnie Sturfele, my partner here at Incrementum. And it's a very extensive study where we not only talk about gold like in a narrow sense, but like the broader implications of the monetary system and so on. Because if one wants to understand gold, one just needs to think about all these kind of things, which makes it so fascinating for me at the end of the day. And so basically, since we are doing this, we are taking note of these kind of developments, and we actually found Bitcoin pretty early on, I guess 2011, sometime like that, and I think we got it pretty soon on an economical point of view. I mean, we got what the concept was. What was trying to be achieved, namely trying to set up some kind of a decentralized, non-inflatable, non-governmental financial system at the end of the day. We found that fascinating. I mean, it wasn't that we became Bitcoin maximalists from day one, and still aren't, I'd say. But I really one part of me, I mean, I would really wish that this kind of vision, perhaps we could really see this turning out and playing out in a positive way. But that was really early on, and we obviously also thought about from a portfolio management perspective, how could one incorporate this, and how could one sensibly perhaps invest in this as part of a portfolio. And our view was, okay, I mean, even back then, even more, but still today, I think it's valid. It is still in a very early stage. If this thing really monetizes and should be able to achieve what the vision behind it is, then you don't really have to bet the house on it, because the upside is so enormous, because it has to monetize and increase so much in terms of value. It's really pretty easy playing it in a diversified portfolio, and risk budgeting it according to your needs. So just put in a small part of it of your portfolio in there, but then keep it in there, because it has the potential to explode. And that's exactly what we did on a privately, because that was the early days. We couldn't implement it in our funds back then. But we started working on providing a fund solution 2016, beginning of 2017 perhaps, and then that took quite a while. But I think we came up with quite a sound solution. And then again, it's interesting that we are thinking very similar, I think, because you also combining gold with Bitcoin in a similar allocation as we do, actually. So we basically ended up at the same solution, which is, I think, quite interesting.
Yeah. So can gold and Bitcoin they live together? They're not competing; they're complementary, or do you think they will compete in time, Mark?
I think they do compete to some extent by now, but still one needs to put things into perspective in terms of size and market cap and everything. And I think this competition is not necessarily, and it's definitely not an either or. It's definitely a both for me, at least. I think one can make a very consistent case for both assets appreciating alongside, especially in this kind of environment which we are in or have been in, and it has happened also. I mean, gold has been performing again since a few years alongside with Bitcoin. So perhaps if one consolidates these two assets into one kind of category of assets, it may be the case that Bitcoin has taken away market share from gold, but still the market, the general market of these both assets grew faster. So gold can increase alongside with Bitcoin, and I actually expect that trend to continue in the medium term. But still, I wouldn't go all in on Bitcoin, because you have different risks and different volatility profiles. And especially if you combine both things, you can get a much better risk-adjusted return characteristic. And that for us, again, as portfolio managers, is the interesting thing.
And this is music to my ears, Mark, you know, to hear a man of your genius to sing this song. You know, we call the Bitcoin and gold combination bold, which I think is, I think it's an asset for the era. You know, in a disinflationary period, bonds and equities, you have equities for risk on, for the expansionary times, you have bonds for when it's all going wrong and when there's a recession. But everything changes in the inflationary environment, and the evidence is the 1970s, the clearest evidence, or indeed in many emerging markets routinely around the world, from crisis to crisis, whenever they have a burst of inflation. And you know, the gold replaces bonds in an inflationary environment, and Bitcoin replaces equities. That's a very simple argument. I mean, you can bring in commodities, and we can be here all day. But you know, these are the two things. And if you don't mind, I'd like to just ask you, and I apologize, Charlie, because it's slightly out of the blue. I mean, gold and silver, right? There's a big difference, isn't there? Bitcoin and crypto, there's a big difference. What are your thoughts?
Well, I'd argue that gold and silver are more similar to relative Bitcoin and rest of crypto, personally.
That's true.
Silver is we call it, it's kind of a hybrid metal. It has monetary characteristics, but it's obviously much more an industrial metal than gold is. And that's also interesting from an investment point of view again, because I mean, a part of the case for gold, the investment case for gold, is, in my view at least, that it has been demonetized to some extent. Oh, it has been demonetized, and then it's also even its role as store of value when you think about central banks again, has diminished. I mean, not recently, but say in the 80s and 90s, obviously, especially, and only since 2007, 2008. Central bank holdings in gold have started to increase again. So part of the case for investment in gold is that it's kind of, wouldn't call it remonetized again, but it's being rediscovered as a store of value, as an international reserve, for instance, and if you think about things like this, silver definitely has been demonetized completely, and also its role as a store of value has basically diminished. Of course, you have some kind of a few silver bucks left still who are stacking silver, but in the grand scheme of things, that's I think not really a big thing. And the market is so much smaller, so you just need some financial demand, which is obviously in market cap, huge money flows going into this rediscovery process of silver, for instance, or gold for that matter. But you have higher leverage basically on this kind of remonetization, or whatever you want to call it, in silver. So the fact that its monetary role is more insignificant from silver relative to gold, that makes it interesting from an investment point of view. And again, one can use some kind of diversification effects if one supplements a gold portfolio with some kind of silver. One doesn't necessarily have huge amount of higher volatility if one does a sensible asset allocation, but one can increase the potential returns quite significantly. So silver, I think, is interesting in these times. When you think about Bitcoin versus the rest of crypto, cryptocurrencies, especially for me, is a very problematic term, to be honest, because most of tokens, which are perhaps called cryptocurrencies, are not even intended to be a currency. So if you look at coinmarketcap.com and you see, I don't know how many it's by now, 15,000 cryptocurrencies, they're not even intending to be currency, so it's really misleading. And I wouldn't dismiss some interesting concepts in the crypto world, but I really think one can't view it as a store of value. I think it's more like a tech investment potentially, and there are some interesting projects out there, but they are not competing with Bitcoin in my view. Bitcoin really has very few competitors, and basically it has won every battle by far versus Bitcoin Cash, for instance, perhaps the most prominent example in this regard. Bitcoin is undergoing, I think this is often overseen, a huge competition, a competition of ideas, which is interesting, which is important, which makes it more robust once it succeeds, and it has succeeded every time. So I think the competitors for real payment tokens or store of value tokens, the market is actually pretty small. So I think Bitcoin versus the rest is more different, as I said, as gold versus silver.
Absolutely. I couldn't agree more. I mean, sort of Bitcoin is out there as a very, very liquid, credible asset. You know, Ether has a utility. It's also credible, but it's not a store of value in the same sense. It's a tech stock, and all the rest of it, we should think of them as tech stocks. Gold and silver always gets there in the end. You know, I would say that silver and gold, what's their 100-year expected return? The same. They'll have the same return. I don't know what it will be, but they'll be the same. But silver's unreliable. You have this over the last couple of months. We've had this macro shock, and gold does what it's supposed to do, and silver doesn't. But it will catch up eventually. So by the time everyone realizes there's a gold bull market, silver starts to move. I just want to put a couple of numbers on that for you. Our data has picked up, ByteTree data. We've measured the fund flows for gold, Bitcoin, Ethereum, and silver. Silver's basically had no inflows this year. ETH hasn't had very much, but gold has seen $12 billion come in, which is great. And Bitcoin's seen $500 million this year. And to remind you, in mid-2020, so after the COVID first lockdown to the market top around April 2021, the Bitcoin inflows were about $10 billion. So we've got a long way to go. This can really get motoring. And I suppose, Charlie, this naturally brings us onto market size, doesn't it? We've got a slide for that.
Yeah, let me scrabble around for that.
Yeah. So, Mark, I mean, the size of the Bitcoin market, Bitcoin's $500 billion, gold's, according to my calculation today, $12.8 trillion today. What are your thoughts on all that?
Yeah, that's, I think, the relevant chart in this regard. Yeah, I mean, I think the narrative that Bitcoin is digital gold is well established. I tend to agree to this narrative. I think it has optionality on top of it, becoming even more than just digital gold, because since it has basically a payment system or network embedded. But still, as a starting point, just the overall market cap of gold, I think is quite an interesting one. Although one has to say it is a debatable what kind of metric when it comes to the gold market should one take. Is it only liquid gold, investable gold? Because these $13 trillion which you refer to include basically all gold, also gold which is part of art and so on. So that's really difficult to invest in, but still it can become liquid again. So it's really, I think it gets a little bit fuzzy. But nevertheless, let's just take the whole bunch of it as some kind of a reference point. And I mean, a lot of the Bitcoiners, usually during a bull market, you hear, okay, it will go to parity and gold will be demonetized and go to zero. I don't know. That again, to me also is not going to happen anytime soon. but again, if you think about these 13 trillion as some kind of a reference, some kind of a benchmark, we just saw currently approximately 7 percentage points relative to this kind of market cap we have in the Bitcoin market cap. And I always look at this number. I think it, as I said, will probably rise, but it will rise in waves. And I think for like a 5 years horizon, I think if we go to 50 percentage points, that's quite something. So that's in the cards. I think that's in the cards. But it won't go to parity that fast. I don't think so. That's just my feeling. But whenever it's this market share rises too fast, I get a little bit cautious. We were, I think, in the peak at even 12 percentage points, something like that. Gold was lower back then, in November, even not that long ago, 21. And Bitcoin, obviously, at $69,000. That was quite a rich valuation in my view, just also because it increased so fast. But then again, I think it makes sense to look at both these assets and look at the relative valuation, because I think to some extent these markets do compete, and again there you get the argument and the case for combining both assets.
Yeah. What I'd like to know, because you're right at the sort of coalface of talking to institutions about this, where we are at the moment, I think it's undeniable really that gold is generally from an investment perspective, a highly institutional asset, whereas Bitcoin still really resides in the world of retail. I mean, far and above anything else. The institutional adoption as it's occurred for Bitcoin is typically somewhat maverick, or it's the trading desks of large hedge funds and investment banks who are trying to sort of find their way into it. My question to you is, when you sit in front of people, they'll obviously understand gold. Central banks understand gold. They've long traded in it. Where are we with Bitcoin in your view in that context, Mark?
Yeah, caveat, I'm not sure that so many institutions really understand gold. but I agree, they tend to understand gold better than they probably understand Bitcoin. Now, if you think about, I mean, the institutional spectrum again is probably quite large. One perhaps can break that up a little bit into real big corporations. I would say pension funds and insurance companies, which really control very big pools of capital, and obviously are very institutionalized in terms of their decision-making processes. They are having a very hard time, or there's not much going on when it comes to Bitcoin in these kind of institutions. Depends where you want to put in, because you just talked about retail versus institutions. In the middle, somewhere probably there's family offices, so private wealth, high net worth individuals, and I think this is kind of the part of the more institutionalized managed money, if you want to put it that way, which is dipping into this kind of asset class. I mean, it already is involved to some extent, depending on obviously on the family office and so on. But just also from a governance point of view, a family office typically is managed leaner as a insurance company, definitely. So you really need to, if you happen to find a family office where only a few people really end up to make the decision, one or two perhaps, and perhaps even also in collaboration of the principal, then I think you've got a much higher chance of them having already entered the space or seriously considering entering crypto/Bitcoin investments, So I think it will work itself up the chain kind of through small wealth management companies, independent wealth managers, family offices. To some extent, I mean, there were some examples, I think, in the US from a pension fund here or there, but very rarely still. But the odd one will pop up also. I mean, they will invest here too, I think. What's also a little bit of a wild card to me, but potentially very important players are some kind of state funds, you know. So, I mean, central banks, perhaps not directly, but
we're talking about sovereign wealth funds and that sort of thing.
Exactly, yeah, sovereign wealth funds. Because obviously, I mean, some of them exist which manage huge amounts of capital, and I think there we could see some kind of surprises on that level also, and the more kind of institutional money, so the more big players enter this kind of asset class, the more the traditional institutions are likely to also go that route, because their risk also basically decrease, their reputation risks. Nobody wants to be the first kind of, and we saw things like that already happening last 2 years when big names from the hedge fund space like Paul Tudor Jones entered the space. Also Ray Dalio has changed its views somewhat, and that helps, I think, but it's an ongoing process, and it will take time.
Yeah, I completely agree. When we sit and chat about it, you know, one of the things we often say, especially now, you know, that the bubble has been pricked from last year, is sort of who's left to sell it. you know, I mean, the frothy speculators are kind of out, and on the flip side, you can really gamify this situation if sovereign wealth funds, in any shape or form, or even giant, but you know, big institutions start to buy it, it becomes a signal to others to do the same. You can't be left behind if something, you know, to go back to your very early point, if the structure of central bank asset, you know, balance sheets is going to shift over time, you cannot be left behind. You know, there'll be a stampede at some stage, I think. So I find the price behavior of Bitcoin at the moment absolutely riveting, because by all accounts, you know, in a rising interest rate environment, inflation going crazy, high risk exponential growth stocks collapsing, you'd expect Bitcoin to be having a seriously hard time, and it's not. You know, it's treading water, which I think is fascinating. And on that basis, do you have any kind of valuation kind of, you know, methodologies you stick around gold and Bitcoin, or do you just more look at the kind of regime that we're in to sort of go, you should be owning this, and you should be owning it in kind of this type of size?
We looked at different valuation metrics, and I mean, there are interesting models out there, but at the end of the day, I wouldn't bet any kind of money on any of these models, to be very honest. So our approach is much more humble. I think we thought hard about really setting up a sensible asset allocation, and basically one premise was that volatility, relatively high volatility of Bitcoin, is here to stay, and we want to let the volatility work for Bitcoin's volatility work for us. So we rebalance in a structured manner, and so basically whenever Bitcoin outperforms gold, at some point we take profits and reinvest into physical gold, and whenever Bitcoin falls relative to gold, at some point we take some of the capital from the gold side and put it back into Bitcoin. So it's really not us trying to outsmart the market. but just really to be consequent in this kind of investment approach and let volatility do its thing, and automatically will be relatively we will always sell relatively high and buy relatively low. We will not sell at the perfect point in time probably, and we will not buy at the absolute perfect point in time. But I think whoever has been managing assets personally or professionally for a while knows that that's not something which is realistic to do on a consistent basis. So I think this as a starting point is actually quite good, actually.
So Mark, I've got a philosophical question for you. Now, I know that the supply side of Bitcoin is well known, that story is well told. The demand side of Bitcoin is more curious. And I'm going to ask you a very simple question, and I'm going to give my answer when you're finished. But I want to hear your answer. Why is Bitcoin valuable?
I think there are many facets to that. First of all, it's potentially a new monetary system. It could turn out to become a new monetary system. So it's a call option on a new monetary system, and a very cheap one in my view. Because if it becomes a new monetary system, it becomes very valuable by definition. If one goes into this a little bit deeper, I don't know if you're alluding to this kind of angle. A lot of times from the gold side, you have this argument: Bitcoin has no intrinsic value. I can hear what these people are saying, but I think they are wrong from a philosophical point of view. Also, when one thinks about it from the Austrian school of economics, because according to the Austrian school of economics, there is nothing like an intrinsic value. Every value is subjective. So it's but the intrinsic value argument, I think, is perhaps misrepresented. The intrinsic value argument is basically one can do something with gold. Gold has interesting properties and so on. So again, from there derive subjective values for people. Perhaps we could consolidate these two views to some extent.
I think you've done well. I mean, the option on the on where this technology could take us, absolutely, there's a value in that. And I guess it makes sense because options are always volatile. So that would explain some of the volatility. But I think the other thing that the average investor sort of grown up in financial circles doesn't understand is the value of networks. Mm-hmm. And, there's lots of terminology that's wrong in crypto. You said earlier cryptocurrency. They're obviously not currencies, they're assets. And that's pretty clear. But I think people aren't really understanding a thing like market cap's another one. So market cap's also a kind of, I know we use it, but it's actually a bad term because it assumes that you can buy all the Bitcoins, right? And so some big company, Berkshire Hathaway, come along and take over Bitcoin and have all the Bitcoins. But that would be really stupid, because if you did that, then there's no network. And so you think, well, hang on. The most valuable part of Bitcoin is the fact that 100+ million people are engaged with it. And they believe in it, and they know it's liquid. They have faith that it's liquid tomorrow and the day after. And they believe that it's going to work, and they can exchange it to a vast number of people. So the network, and I'm not talking about the network effect as in it catches on. I mean, there's a bit of that, but it's really the network itself, which is so powerful. And it's, looking at the Bored Apes Yacht Club, which I just think is quite funny. One of the things I like about crypto is it's got lots of humor. And it's just much. The old world of finance is quite dry, isn't it? But crypto is just funny. There's always something to make you laugh. When there's a sort of serious side to it, and then there's a big joke comes along. And Bored Ape Yacht Club, there was an airdrop where they gave away loads and loads of apes or coins or whatever to the general public. And you kind of wouldn't do that in normal finance. I mean, it'd be quite rare. Maybe if you had a strong brand, you might give your favorite customers some shares or something, but not really. I mean, it would be very strange to give away, say, 20% of your company. But actually here in crypto, you're doing it out of self-interest because the airdrop creates the network royalty. And, you know, without those people having them, then there's less chance of your network coming to be. And so it's a really important point. You know, and so people say, okay, well, I'll cut and paste the Bitcoin code, make you know, Bitcoin SV or some rubbish like that, and you know, they were forking the blockchain to try and take the network. So rather than launching a new coin like Dogecoin or Litecoin, it's actually quite hard to get it to catch on. So by forking the network, you're hopefully getting the network, but then there's still going to be a winner takes all. You still got to, everyone's got to go one way or the other, and every time they've come back to Bitcoin. Exactly. So it just proves that actually the value of a network is huge. In fact, what we're trying to do in crypto is find out what the value of a network really is.
Right, and I mean, there was one last part of a thought which I wanted to add, but that actually matches your comments very well. I think monetary premium. I mean, if you what's the biggest network? Money, I guess, right? I mean, because money is part of every single exchange in an economy. So the monetary premium is something I think which is also not understood very well by people, because I mean, oftentimes, again, gold critics say, put my Bitcoin hat on again. Gold critics say, well, gold has no use case, which is absolutely a stupid thing to say. It's a very interesting metal. It has extremely rare properties. One can use it in an array of industrial solutions and technologies and so on. But usually it is substituted by other metals with similar characteristics, probably not as good as gold, but similarly good. And why is that? Because the value of it being a monetary metal exceeds the physical value, or the industrial value, or the intrinsic value, as they perhaps would say. And so I think it's important to understand, whenever something becomes money, it becomes it has a monetary premium which is being priced in or being priced out, for that matter. Silver being an example which had a monetary premium, and it was priced out starting at the end of the 19th century, I guess, until in the mid 20th century. You can see it in the gold-silver ratio. So the price relative, the silver price relatively fell sharply because people didn't use it for these small transactions anymore. The money was more scalable with banknotes and so on. So it goes both ways. Just to make that clear. But I think the main debate is can any asset become a monetary metal? A monetary asset out of nothing, and by that price in a huge monetary premium. And I think we are already seeing the answer basically for 12 years. So coming from nothing, Bitcoin just got this network, increased its network, and is continuing to increase its network, and hence also its monetary premium. I think this is how one could consolidate these two thoughts to some extent.
Again, a question slightly out of the blue, but just turning all this on its head, we've got circumstances just about everywhere that should make us certainly bullish on gold. I think very bullish on Bitcoin. What are the circumstances, though, do you think that might make you bearish, that would turn that view around, Mark?
Both assets, you mean, or for one particular asset?
Yeah. Gold for starters.
Well, I mean, what's really a bad environment for gold historically. It's well established. If you have positive real interest rates, and we are so far away from this kind of environment that I really can't see this kind of scenario happening anytime soon. I mean, one can make the argument that even rising real interest rates from the negative level, like if you take the official inflation rate, take the US, 8 percentage points, something like that, consumer price inflation, 0% inflation, 0% interest rates is minus 8 percentage points of real rates. So if this minus 8 would increase to minus 4, something like that, for instance, one could make the argument even that already is at the margin negative for gold. That could be for a while, but I think in order to really end this bull market, which hasn't even begun in my view, one would probably need a longer term increase, and at some point positive in real rates. One would need positive real rates, and I just can't envision the scenario that this is going to happen anytime soon. So,
what are the chances out of 10 of another Volcker moment?
Well, the problem is that if somebody came along in any significant central bank and really would become so hawkish, I mean, they would kill the economy. So my partner wrote a book with a few friends of ours, Zero Interest Rate Trap. And I think this term actually already says it all. We have, through this zero interest rate policies, which has been going on for over a decade, the addiction to debt and the levels of debt have increased so much that that's the reason why they can't do it at the end of the day, because they are addicted to the zero interest rates and low interest rates. And if they would have to refinance, and that goes for the government, but also for the private sector and the corporate sector, if you would have higher interest rates for a while, so long that the whole economy has to refinance all its debt with these newer higher levels of interest rates, the cost of the interest rates just gets so high, the economy gets crashed. And I don't see this coming from a politically, it's not feasible from a political point of view. So it's going to be very, very interesting where we are going in this decade, because at some point, and that also has to be clear, at some point, if inflation keeps on increasing, the trust in fiat currencies may really be in danger in a broader sense, and at some point, perhaps they will have to do something like that. I don't know if they will be able to pull it off, but right now I'm very comfortable with gold and Bitcoin.
So, I mean, we're coming up to the end of the hour, so we'll wrap it up soon, and we'll hopefully just get a couple of questions in. But I just want to bring in the Russia-Ukraine situation because it's so important, and it's dividing the world. And my analogy is the aeroplane groups, One World and Star Alliance, and we're going to a One World Star Alliance type hub network system. And Boris Johnson was today lobbying for Russian gold reserves to be sanctioned, like they did with the dollar cash. I mean, if we go into this new world, I mean, obviously, as you were saying offline, so what? Russia could sell its gold through China or what have you. But if you go into this new world, do you think that at the margin that's better for gold or Bitcoin?
I agree. I think we are already in this new world. It's forming up, and it's been developing, but obviously since 1 or 2 months now, this has been increasing hugely. This division, which you alluded to, and yeah, I mean, the big advantage of gold relative to Bitcoin in that sense is that gold is anonymous. So I mean, you can sanction gold whatever you want, but gold is super fungible, and one gold bar is as good as the next gold bar, and that's not the case in Bitcoin. I mean, since you've got every transaction on the blockchain, one can make the argument in this case that gold is superior, and I really can't imagine how this kind of sanctioning would work in practice. One can obviously say, okay, we will not buy any Russian gold bars when they have a Russian stamp on it, but you can melt them down and put whatever stamp on it, and it will always be valuable, right?
You can put the gold bars back in the mine, dig a hole, and go, wow, refined gold.
Exactly.
Yeah.
So I don't know how they imagine doing that in practice, but it's not possible in my view. It's not possible. So that makes it attractive. It's the ultimate money, and it can't be sanctioned.
Do you remember the advert that Barry Silver from Grayscale did last year about ditch gold, buy Bitcoin or something?
Right.
How did that make you feel?
Well, I mean, I totally can understand his position. I think he initially collected, how much was it, 2-3 percentage points management fee for no management service. So he obviously, wanted to pitch his product. It's fair enough. But that's the typical extreme Bitcoin emotions which he was catering to successfully, I guess. But in my view, it's a very narrow-minded view. Both assets have advantages, and both assets have disadvantages. And I think this conversation one has to have on an objective way. And that's at least how we are going around this.
Absolutely. Mark, a couple of crypto-y questions are coming in for you. The first is, what are your thoughts on Ethereum and any potential flippening? And the second is this halving cycle delayed, over, or broken?
Yeah, well, I start with the second one, if I may. The halving cycle is in a very so halving cycle obviously refers to the stock to flow model, and we published this little Bitcoin chart book 3 months ago, where we actually thought about exactly this question. And so thanks for pulling up the slide. What we see here is the performance of normalized performance of the last 2 halving cycles, full halving cycles, and the current halving cycle. And the thing is that the first 2 full halving cycles ran somewhat in tandem, and basically this is the pillar for this very well-known stock to flow model. And again, also this halving cycle started very similar. So the model, I think, still is helpful, but again, I wouldn't trade on this model, and it also probably is not really realistic to trade on this model, because the model allows for a huge deviation of kind of the target price without being broken. So our view was that it's probably pretty likely that this halving cycle is not over yet in December. Honestly, I think the chances have decreased. So we could have seen the peak in November, because I mean, one has to also ask oneself how delayed can this halving cycle be without this invalidating this model. So I'd argue one would have to see a new peak pretty soon, perhaps until summer, kind of. Then one probably could argue that this is part of the cycle still. But if we don't see it in summer, I think either this cycle is over, or even the model doesn't apply anymore, is invalidated.
Yeah.
So I think it's probably perhaps 50-50 now, or perhaps even 40-60 against the odds that we'll see a new high before summer. When we published this, we said it's 60-40 in favor of seeing a new high. So it's to be judged yet. So the jury's out. But we could see a new high, and then things could move rapidly again. Currently, it doesn't look like it, but things can change pretty fast in the crypto.
Yeah, I mean, what I see there, Mark, is a model where the first halving had a big impact, the second halving had some impact, and the recent halving have had less impact. So each halving has become less and less relevant.
Right.
The demand side of the equation becomes more and more relevant. And I think we once calculated that Bitcoin had doubled. Was it 22 times, Charlie? Something like that, or 19 times, was it? And I think we could attribute 3 or 4 of them to halving, and the rest of them to boost in demand. And it's like you've got to grow the network, and you've got to give reasons to people to get involved. And I think the macro becomes more and more important in future. And the institutional fund flows, the demand side, those miners have got to be paid every day. And so the supply demand balance is really, really important. And they say, okay, well, the miners aren't selling Bitcoin anymore. Well, that might be true that in 2021, when money is freely available for rubbish projects, that you can raise capital infinitely at low cost. But that won't be true in a couple of years' time. So you've got to assume there's a real cost to this. Yeah. I think it's all looking good. It's just, I haven't been so bullish on Bitcoin for quite a long time now. So I'm really quite excited because of the sentiment on the street. It's shot to pieces. Everyone's really bearish. I'm really focused, Mark, on the Bitcoin Nasdaq, Bitcoin S&P chart.
Mm-hmm. Me too.
I love that chart. I guess it's very, very exciting to see some relative strength. And you could basically got the mainstream indices and Bitcoin. They're kind of aligned these days, and it's not ARK. In prior cycles, 2014, 2018, Bitcoin would have followed ARK straight down. It hasn't done this time.
Right.
It's up there with the big boys, and that means it's credible, and that means that virtually all institutions on this planet are yet to buy it and haven't yet bought it. That's the bull case. There's a lot of money coming. There's hundreds of billions of dollars yet to come. When you go to your high street bank, I think you're in Liechtenstein, so you probably only have private banks. But if you were at a high street bank in London or something, and you went to some Lloyd's Bank type place and asked your whoever looks after your portfolio, do I have Bitcoin yet? Maybe you got some through your S&P tracker because you got some Tesla. You got a little bit. But you're still going to have a whole lot more. And until that guy says, oh, yes, here's our crypto strategy in your retirement, this thing is not over.
Yeah, agree.
Any thoughts on that Ethereum question?
Right, yeah. So flippening, I think it's basically considered to be kind of Ethereum being the better store of value kind of.
Or larger, I think.
Larger even, yeah. I mean, one big vector in the crypto space when it comes to institutional flows, obviously, is liquidity, and is kind of the embedment of cryptos in also the traditional exchanges and the whole traditional system. So I think Ethereum obviously is doing a good job. So look at, for instance, the CME incorporated Ethereum futures, I think, over a year now. So started with Bitcoin futures, obviously, added Bitcoin options in 2020, added Ethereum futures last year, I think, and is now apparently adding Ether options as well. So this, and obviously no other cryptocurrency. So that just one example, but that just showcases this kind of race when it comes to making these kind of assets liquid. and it is up there. It is up there next to Bitcoin. Obviously not as liquid, but it probably has caught up in terms of the relative liquidity and all this kind of things. So still, when it comes to the safety, and when it comes to the decentralization, when it comes to the store of value aspects, I think just the fundamental architecture of Bitcoin is much more important, and is very unique. Obviously, this highly decentralized network, when it comes to being considered, as I already mentioned, by, for instance, family offices as a viable asset. So whenever one thinks about store of value long term, and when one really thinks about the fundamental safety and the construction of the thing, I think Bitcoin will, in the medium term, win. So Ether is out there. It's more volatile than Bitcoin, but it also will stay more volatile than Bitcoin. It had higher returns 2021, but it will also have potentially higher drawdowns. So I see it as a higher risk version, and definitely not as a store of value case like Bitcoin.
Yeah, fair enough. Well, I think on that note, it's a brilliant note to end on. I think we're very much in agreement that the preconditions are there for a sustained performance, particularly of gold, but that Bitcoin is wonderfully positioned, given its lack of ownership and so forth, to follow in the coattails. Mark, thank you so much for sharing your experience and knowledge with us. It's been great fun. I hope we can come out and see you one of these days for real. Very good luck with your funds over the next few years. I was sort of thinking about kind of asking you to give me a price target for next year, so we'll get you back and hold you to it. But I think that's a bit unfair, really. But anyway,
I'll give you one. I'll give you one word: higher.
Higher. Okay, we'll take that. We'll take that.
And Mark, do you know how you get these twin towns, where you take a village in England and it twins with a village in Austria or something like that?
Yeah.
Well, I think that ByteTree and Incrementum should be twin firms. I'm going to send the mayor of ByteTree over to visit the mayor. Okay,
that's nice. Yeah, I like that. I like that, Charlie. Thanks for the invitation. Enjoyed it a lot.
It's not a legal arrangement. It's just a sort of aligned,
friendly arrangement.
Friendly link.
Yeah. Good.
I'll accept it. Yeah, that's cool. Thanks, gentlemen.
Many thanks. All the best.
Bye-bye.
Take care.